Hey, good morning, everybody. Hope your Saturday's off to a good start. Saturday before Thanksgiving. So it's either probably a really hectic time for you or pretty laid back. So, usually this could be a laid back time for folks, or, they're kind of slow at work, but some people, it's just crazy time of year. So either way, I hope you're going to be able to enjoy Thanksgiving. I actually get to, it's funny, I usually the only time I ever get to see the Detroit Lions play, I grew up in Michigan, so I was a Lions fan. The only time I ever got to see them play was on Thanksgiving because this tradition, the noon game was the Lions. And out there actually kind of winning some games. They've been on national TV a couple times now, so it's kind of crazy to see the Lions on TV. Even as a kid growing up, the rules were very different back then, that you had to sell out the stadium or they wouldn't air the game locally. So I didn't really get to see Lions even when I lived in Michigan because they never sold out because they're always so bad. But anyway, off on a tangent there. Today I'm going to kind of veer away from economic and stock market stuff and talk about something we really need to think about here as we're approaching year end is some taxes. So taxes are always a big issue. So we're going to look at that stuff today. And then, maybe we'll next session, which will be kind of in December, I'll jump into some really hardcore economic stuff, maybe some outlooks for 2024. It's always fun to guess, so you can look like a complete idiot at the end of the year that you were way off. But so that's what we'll probably do. But today I just want to talk a little bit about some tax issues. And these are kind of the most pressing items that are there. Taxes, you could talk for days on it and it could bore you to death, but we'll hit on a couple things I'm going to be talking to quite a few of you about before year end. So we'll jump into our slides as always. Okay, so we're going to talk about an alert that the IRS basically published just recently. And then the big thing will be Roth conversions. That's what I really want to talk about. But we'll start off with this, and it's kind of sort of a shot across the bow. Now, the IRS has a process where they'll issue alerts to taxpayers. And usually these alerts are, dealing with, how to clarify a certain tax law, or it could be a lot of times it's about how to, keep your identity safe and what to do if it's breached, or, it's sort of technical stuff. But just recently, they basically came out and said, hey, you guys better give us our money during the year or we're coming after you. Penalties and interest are coming. And I'm starting to see this a lot, for the tax business that we have. It's really started at the state level. So Maryland has just been a real stickler on the rules as far as, if you underpaid during the year. And it used to be kind of flexible, but now they're really coming after you if you didn't pay every quarter. They're being inflexible about it. So I've even had a client get a letter from Maryland that I think they owed $1.27, which is kind of ridiculous. I mean, it's going to cost them more for the postage and everything like that, but that's what they did. So the IRS is starting to do this as well. This year, we've seen more letters issued to people who owed money than we've seen in the past. And sometimes it's they just owed a lot, or sometimes, again, it could be from quarter to quarter, the IRS did not get all the money that they should have gotten. So maybe somebody made a quarterly payment at the end of the year for a big chunk. So they go back and say, well, you've got some penalties and interest for the first, second, and third quarter. So when I saw this, I was like, if the IRS is basically letting people know that this is coming, then there's going to be a lot of letters. And the biggest problem is when they made the changes to the W-4 back with the Trump tax bill, people have been, especially dual income families, have been under withholding substantially for years now. So we'll talk a little bit about this. And this can be sizable because essentially the interest rate that the IRS charges on underpayments is now going to be basically the short-term interest rate, the federal short-term interest rate plus 3%. So right now, they publish this every month, but right now at this current moment, it's charged at 7%. So you're going to be charged 7% on the underpayment that you that you have. So it can really add up pretty quickly here. So as I mentioned, with the Trump tax bill, they changed the way they do the withholding. So it used to be, I've got all the time I have people, that owe a lot, and they're like, well, we did married one, we have 2 kids, or I did single 0. That whole married 1, married 2, single 1, 2, that doesn't exist anymore. That's no longer a thing. That's not how they do it. So the new W-4, what it does is it basically, if you say you're single, if you're married, filing joint, or head of household, the IRS then uses those tables. You remember the tables that you used to when you did your own taxes, and you look at the back of the book and you found your income and saw what your tax was. Well, they still use those tables, and they say, okay, you're married, filing jointly, and your income is $100,000, so your tax is X. What they assume is that your income is the only income for the entire household. So what ends up happening here is if you don't take adequate measures to adjust for the dual income, if you don't take your spouse's income into effect, you're going to be under withheld at the end of the year, because for each spouse, the government's looking at their income as the only income for the household. They're not adding both incomes together. So this is why we're seeing so many issues with withholding. And it's mostly for married couples, honestly, but it even affects some single folks and things along those lines. So this is sort of the W-4. Also, as you go through the new W-4, it does take in effect if you have dependents. So, if you have children under 17, you can get the $2,000. If they're other dependents, you get $500 per dependent. But the other thing, the big part is this step 4, the other adjustments. And this is where you really need to focus if you're a dual income household. Specifically 4C for the extra withholding. Now, what they have is a chart, which most people don't know. It's on like page 3 of the W-4. So what you need to do is, this is where you adjust for both dual income. So on the left side going down, that's for the higher paying spouse. So you go and you find, okay, what range are you in for your taxable income here? What's your salary? And then at the top, along the top axis, the x-axis, is the lower paying spouse. So, basically you just find these two together. So let's assume the higher paying spouse makes $150 and the lower paying spouse makes $70. So that means you need to have another $13,180 when you come across both of those. You need to make sure you have another $13,180 withheld between both spouses. beyond what they normally would. So this is why we're seeing people owe, because again, they're not adjusting for the dual income. So most people, they hate using these tables. They don't understand them. They don't know how to do it. So what I tell tax clients is, well, the easy thing to do is, all right, if in 2022 you owed quite a bit of money, you just take the amount you owe, divide it by the number of pay periods, and that's what you want to put in box C, step 4, box C, for the extra withholding. So, real simplistic, if you owe $2,600 for your 22 taxes, you divide that by, most people have 26 pay periods. So you essentially have an extra $100 per pay period withheld, and you're good to go. So that's the easy way to do it. So you fix your W-4, you go back in, divide it by the pay periods, real easy to do. So you don't have to worry about charts and, following all the steps that the IRS have and everything along those lines. Now, a lot of people might be self-employed or retired. So this is where you might run into the situation where you need estimated payments. And I used to always kind of do some estimated payments. And then the last payment of the year, I'd really do kind of some tax planning for myself, and then, make a bigger payment at the end of the year if I've made more money during the year. And, at this point, the IRS is probably going to even come after, folks like me because they want equal payments throughout the year. So I'll get some penalty for underpayment for the first 3 payments of the year. So, it's going to be important for everybody to know when to make these payments. And you can see the first payments due on, basically the end of tax season. For 23, it was April 18th, and then June 15th, September 15th. And then you have up till January 16th of 2024 to make the payment for the fourth quarter. So any payment made in early January before the 16th will be assumed it's a payment for 2023 taxes, not 2024. So if you are behind on your taxes, you're still probably wise to make a bigger payment in January. You might still get assessed some penalties for the first 3 quarters, but at least you can reduce the amount of penalties you're going to see, penalties and interest, because it's at 7%. Now, it's always been in the IRS code that if you underpaid for some quarters and maybe made the payments at the end and the fourth quarter, they could technically come after you, but they usually didn't. It wasn't something you saw that often. But it sounds like they're really starting to come after people now. They need, when you have a $1.5 trillion deficit, you really need to, annual deficit, you need to find every dollar you can. You're opening up the couch cushions to try to find those nickels in there. So that's what they're doing here. Now, retirees I always have problems with retirees, especially once they first retired. So a lot of folks don't set up withholding for Social Security or their pensions. So you definitely want to do that. You want to make sure you have your federal income tax withheld from Social Security and any pensions you might have, or you're going to have to do quarterly estimates. So again, when the IRS is kind of more lenient, if the retiree made a payment even at the end of the year, they kind of let it slide. They're not going to do that anymore. So you want to make sure that you're withholding enough from both of those to make sure that you're paying enough in taxes. Now, if you're making an IRA distribution, the rule there for not just IRAs, but any income that you have, there's a rule called constructive receipt. So it's basically saying at what point do you actually have control of that money? When do you have it in your hand? When can you spend it? So as soon as you have constructive receipt, the IRS expects to get paid. So if you're making a distribution from your IRA, a lot of clients, I've got a lot of clients right now, we do it in the, last couple of months here, November and December. Well, they're not going to come back and hit you for penalties for the first, second, and third quarter because you didn't technically have constructive receipt of that income. So as long as you make the payment in this quarter for the income that you get, you're going to be okay. So you can, and with IRAs, you can either have them withhold it straight. When they make the IRA distribution, the brokerage can withhold taxes, or you can make an estimated payment, whichever you like. But technically, because you didn't have receipt of it, then you're okay to pay the tax at the end. They won't hit you for penalties for the first three quarters. Now, if you take your IRA distribution in, let's say, August, well, they're going to expect you to start paying with the September estimated payment and the January estimated payment. And this rule of constructive receipt is anything. If you do stock options, if you, really, if you get a sizable capital gain, anything like that, they do expect you to make a payment as soon as you have that money, as soon as you've made the taxable event where you control the money. Now, there is a safe harbor so that you won't have any interest or penalties assessed to you. And there's a couple different ways to do it. So the first one is if you owe less than $1,000, you don't need to worry about it. They're not going to come after you for any penalties or interest, unless they could still come back and say, well, you didn't make enough in payments in the first, second, third quarter. They can still assess you for that if the income is something you see throughout the year. So here again, if you're getting Social Security or if you're getting a pension or self-employed folks and you're making money throughout the year and you just make a big payment at the end of the year or that January payment, and so you cover your taxes enough to owe less than $1,000, they still might come back and say, well, because you were getting that income throughout the year, you had that constructive receipt through all 12 months, you should have been making payments. We're going to assess penalties for the first, second, and third quarter. But generally, overall, if you're doing a normal withholding, you're abiding by the rule of constructive receipt, and you owe less than $1,000, the government can't come after you. Secondly, if you paid more than 90% of the previous year's tax liability. So, for instance, if your final federal tax bill, not the amount you owe or got a refund on, but your actual tax liability after you figure in either standard deduction, itemized deduction, and your credits. So your real bill, if you paid more than 90% of that this year, as opposed to what you owed the year before, that's a safe harbor. They won't come after you. Or I'm sorry, I should say this year's tax liability, 90% of this year's tax liability. So if for me, when I started my small business, I saw my income go up over time, started from barely anything to moving it up. So I just need to make sure that I paid at least 90% of, this year's tax liability, and they left me alone. Or the third part is if you paid 100% of last year's tax liability. There's a caveat though, if you make more than $150,000, it has to be 110% of last year's tax liability. So here again, if as a self-employed, if I at least paid 100% of last year's tax liability, or 110% if I made more than 150,000, I was okay. I wasn't going to be in problem. So what I always try to focus on is either paying 90% of the current year's liability, or 100% or 110% of last year's liability. And because I always like to owe a little bit, that's just me. I'd rather have an interest-free loan than give it to the government to have an interest-free loan. That's just me. Why give the government any money for them to just hold it and not pay me? So that's a general rule. So there is a safe harbor for the most part, although, like I mentioned, if you are getting money consistently through the year, they could still come back and assess penalties for the first three quarters if you haven't paid in enough. Okay, so that's the first topic, and I wanted to bring that up because it's pretty rare for the IRS to issue an alert that's sort of kind of telling them, "Hey, make sure you pay your money to me." Just think of the mobsters coming, and coming into your restaurant, and if you haven't paid, they're not going to be real nice. So that's sort of what this was. This was the mobsters coming in saying, "Hey, give me my money. You got to pay me." So it's something I think we're going to see a lot of letters this year, mostly because dual income families have not adjusted their W-4s. Okay. So the next thing I want to talk about, and this really pertains to a lot of clients who are retired, is talking about Roth conversions. So I'll be approaching quite a few of you here in the incoming couple months here about doing Roth conversions for the year end. So Roth conversions can be a fantastic thing to do in certain situations. Now, first off, so many people, while they're working, their main retirement vehicle is their 401k or 403b, or if you're a government employee or TSP. So they put their money in there, and then kind of whatever's left, they spend it. They use it for living expenses. So they just build up a lot of money in these tax-deferred retirement vehicles. So it's by far their largest retirement asset. And I'll tell you in a little bit why it's important to think about Roth conversions if this pertains to you. Another good reason to think about a Roth conversion is if you don't anticipate you're going to need all your tax-deferred assets for living expenses, it's definitely something you might want to think about. The third thing is if you want to kind of build a consistent tax rate in retirement, and I'll talk about this in a second, but it's another good idea to think about doing Roth conversions, especially if, number one, where you have that huge or big tax-deferred retirement vehicle savings, because I'll show you'll end up paying a lot of taxes later in life if you don't manage your tax rate during retirement using Roth conversions. But the biggest reason to really think about Roth conversions for most people is if you plan or you would like to leave an inheritance to your children or grandchildren, the Roth conversion is critical. And the big reason is a change in the law in 2019, the Secure Act, changed the way that beneficiaries have to deal with IRAs. So the rule previously to 2019 was if you inherited an IRA, you had to take a required minimum distribution every year over your life expectancy. So it really wasn't going to be that much of a distribution. If you inherited an IRA when you were in your 40s, you had basically 50 years to pull that money out. And if you left it to grandchildren who were 20, they had 70 years to pull this money out. So the amount that they'd have to take every single year wasn't that large. So it didn't create a huge tax liability. However, if the way the rules are now is any IRA, whether it's a Roth or a traditional IRA or a 401k, 403b, if the beneficiary gets that, they have 10 years to drain that account. So they've got basically 10 years. So you're going to accelerate the amount that you have to pull out. So go back to that 40-year-old. He or she would have had 50 years to pull that money out. Now they have 10. So you can see it's going to create a much different taxable outcome for the beneficiary. They're going to have a lot more of taxable income if it is a tax-deferred retirement vehicle. So a lot of times when children inherit these traditional IRAs or 401ks, they're typically in their highest earning years. So they're, maybe mid to late 40s, in their 50s. So they're earning their peak earning years. They're in their top tax bracket. for their lifetime. And now they have to pull a substantial amount of money out over a 10-year period. So they're looking at getting pushed into possibly a much higher tax bracket. Now, the only nice thing about it is they can adjust it a little bit. They have 10 years. You don't have to take a required minimum distribution each of those 10 years. You can do it however you want. You could take it all the first year. You could wait till the 10th year and take it all. You could split it evenly, or you could do some tax management to try to make sure that you're not getting hit too hard. But if you get that money into a Roth IRA, your beneficiaries still have to take that money out over a 10-year period, but it's not taxable to them. So you can start to see the power of the Roth conversion. And the reason I talk about you might want to think about doing this, especially if you have a large a traditional IRA, 401k, 403b, TSP. It's the way that the required minimum distribution rules work. So what people don't realize, what I usually find most folks will do is they'll retire maybe in their 60s. They don't take anything out of their IRA. They wait till the RMDs have to start. And then they just take the minimum RMD. Well, the problem with that is, if this account is growing, the amount that you have to pull out every year goes up. So it's all based on life expectancies. So right now, for most people, you have to start required minimum distributions at the age of 72. So if you look at this chart and you look at 72 and you go the next number over, it's 27.4. What does that mean? Well, that's what the IRS is assuming. That's how many years you have to distribute this money. But the way it works is you take the balance of your IRA for the end of calendar year, the previous calendar year. So in this case, when we get into 2024, they're going to look at the balance at the end of 2023, and then they're going to divide by 27.4, and that's the amount you have to pull out of your IRA. And as you notice, if you look at this chart, the number goes down, obviously, every single year, because that's what happens with life expectancy. So by the time you get into your mid 80s, that number ends up becoming a situation where you're pulling a lot of money out of your IRA. So if you're dividing it by, look at age, say 89, it's 12.9. So you divide by 12.9, you're pulling a lot of more money out. So what I end up finding is people get pushed into higher tax brackets as they get older, when if they had used some Roth conversions or pulled more out of their traditional IRA, even to put into a bank account or a traditional taxable brokerage account or something like that, they would have been able to kind of smooth out the tax bill over time. And let me give you an example here. So this is the basically the RMDs for somebody, and this chart uses age 70 and a half, which used to be the rule. Now it's starts at 72. Could actually go up to 74, but for right now, we'll just look at this just to give you an idea. But this was I used a $2 million IRA. So if you had $2 million and they're using that 27.4 life expectancy figure, so the first year that retiree in this case would have to pull out about $72,000 at the first year of distributions. But by the time they reach the peak at age 91, if they made it that far, they'd have to pull out $129,000. So, a lot of times what you see because that's $57,000 more, they get pushed into a much higher tax bracket. when you factor in Social Security and interest and dividends and all this other kind of stuff. So what you really want to do is try to, rather than have this graph go upwards as you age, you kind of want to make it just flat over time. And that's what Roth conversions sort of allow you to do. Now, the way I kind of approach Roth conversions, for the most part, is we try to fill up your current tax rate bucket. All right. So as you probably know, the federal tax code is a progressive tax code. So as you make more money, your tax rate goes up. And this is a chart that shows you the tax rate for both a single person and then married filing joint. So you can see you start off at 10%, jumps to 12, all the way up to 37%. So let's say, for instance, it's a married couple and they have 100,000 of taxable income. So taxable income, again, is going to be after your either standard deduction or itemized deductions, and then any credits you've got. So, 100,000 of taxable income is really, when you take the standard deduction of roughly 28,000, you're looking at a minimum of 128,000 of gross income or adjusted gross income. And then, and if you have some other credits, it could be even higher than that. But for right now, let's say 100,000 of taxable income, you've still got $90,750 in your tax bracket, which is 22%. So what I would typically do is look to see, well, all right, let's do a $90,000 rollover or conversion. Let's convert that to a Roth. So you stay within the same tax bracket, but you don't, you basically don't get pushed into higher brackets. And the other thing it does is it starts to move that money over to the Roth from your traditional vehicles, so that when you do get to your mid 80s or later, you're not pushed into those higher tax brackets and face a bigger tax bill then. So the first thing is just to look at where you at in your tax tables and then fill that thing up. Now, I get a lot of questions from people who are still working that say, well, should I fill up my tax bracket? And typically my answer to that, for the most part, is no, because you're probably in a much higher tax bracket right now because you're working than what you're going to be when you retire. So once you retire, that's when you can start to do Roth conversions and kind of stay in a lower tax bracket and convert the money then at that point. Now, if you really, really want to, start to get money over, that's fine. You could do some Roth conversions if you're employed and you do think that, all right, I've got 15, 20,000. I just want to do it just to get it started, the Roth conversion process. That's okay. But for the most part, you're better off waiting. And then if you retire in your 60s, you've got, maybe a decade or so before your required minimum distribution start that you can do Roth conversions. And then even after your RMD start, you can still convert the amounts above your RMD. You cannot convert your RMD over to a Roth. The government mandates that you take that out, and then, basically you could put it in a bank account, you could spend it, or you could put it in a taxable brokerage account. So once you're fully retired, we want to fill up that tax bracket as much as possible. Now, there are situations, and this is all dependent on the individual, where we might even go to a higher tax bracket and do conversions just to move the money even quicker over to the Roth. Sometimes you look at some of these brackets. If you're in the 22% bracket, going up to the next bracket, it's 2% more in taxes. So it's not like it's a huge jump, and you could put a lot more money away. So going back to that married couple who has 100,000 of taxable income, if they want to stay in the 22% tax bracket, they've got about 90,750 they can convert to a Roth. But if they're like, you know what, we don't mind paying 2% more, they could go all the way up to $364,000. So that's there's a lot more potential to move this stuff over quicker. And you might want to do that for several different reasons. You might have health issues and you think you might not, basically get into your mid 80s or early 90s, and you wanted to make sure that your family inherits a Roth IRA as opposed to a traditional. The other reason to think about it is, and I'll talk about this in just a little bit, but the tax brackets are going to change. So all these tax brackets, the 12, 22, 24, 32, 35, 37 are all going to go back up in 2026. So you might do a little bit more now, knowing that the rates are going to go back up. And here's the chart. So the Trump tax bill or Trump tax law basically changed the rates. So if you look at these two, if you start on the far left, this was before the Trump tax bill. These were the rates and how the income played out. So the 10% is going to stay the same, but what we're now calling the 12% rate was actually 15%. The 22 was 25, 24 is 28, 32 is 33, 35 is the same, but then the 37% rate was 39. And you can also see that the amount of income that you can get in each tax bracket under the Trump tax bill is more advantageous than what it was before. So you got into the, say 25, or you got into the 28% bracket a lot quicker, the 33% bracket quicker, and the 39% bracket a lot quicker. So now if you look over to the left, you've got the current brackets up until through 2025, basically kind of the same as what we're seeing now. The amount of income at each bracket has adjusted. So again, a little bit more advantageous for folks. So the 24% bracket extended out. So you have more money taxed at 24 before jumping to 32. And then the 35% bracket extended as well. So that's good for a taxpayer. But once we hit the 2026, we go back to the tax rates pre-Trump tax bill. So you're going to see essentially a 3 or 4% jump in each tax rate. So again, going back to my example of why somebody might want to max out the 24% bracket. Well, because they can do a lot more money at 24%. And if you look at the chart over at the top of that 24% bracket, that's going to end up being into the 33% bracket starting in 2026. So there is an opportunity where you might want to do a substantial amount more now for this year and possibly next year, and then even 2025. So we still have 3 years where you can do a sizable amount of Roth conversions before these tax rates bump up substantially. So that's probably the big reason why you'd want to maybe go to the next tax bracket. But you also have to take some other issues that you need to be thinking about. Medicare surcharges, the Affordable Care Act, taxability Social Security, taxability capital gains, and then also, looking at opportunities when the market's down. So if the market does go down, you might want to convert a lot more at that point, knowing that at some point the market's going to come back up. Now the Medicare surcharges, basically the way the Part B premiums are structured is the more money you make, the higher your Part B premium is going to be. So the vast majority of people probably see a payment of about $164.90 for 2023. Now, if you go up past the 22% tax bracket, you're going to probably see your Part B premiums jump up to $230. Now, you can argue, is that extra, roughly $66 per month. Is that, does that outweigh the benefits of doing the Roth conversion? I mean, that's something we'd have to figure out. I still kind of think you're better off doing the Roth conversions on the long term. But some people just hate paying that extra $66. And, if you go all the way through the 22% bracket and the 24 and you max that out, you might end up seeing your premiums go up to $329. Now, if you do a big Roth conversion and you pay the higher Part B premiums for a year, well, you can always, or a year or two, you can always, later down the road, you're going to be able to adjust it back down. So the Medicare looks back 2 years at your income when they set your Part B premium for the upcoming year. So even if you do a large Roth conversion in this year or next year, you may pay a higher Part B premium for a year or two, but then it'll go back down and you've converted a sizable part of your traditional IRA to a Roth. So it could make a lot of sense to do that. The other thing that you have to be careful of is if you're under 65 and you haven't gone on Medicare yet, a lot of times we structure your tax return so that you can get a subsidy on your health insurance. So what the IRS, or not the IRS, I should say, what Congress did when they did the Affordable Care Act, as far as subsidies, they only are looking at your 1040, your tax return. You could be Jeff Bezos, and if you structure your tax return correctly, you could get a sizable subsidy. So you can see here, let's say a typical married couple. So there's 2 people in the household. So the minimum income would be $19,720. If you have that income or less, and now I think it's actually 26. So I think this is 2024. Okay. So, if you're around that level or less, you're going to be forced onto Medicaid. We don't want that. But you're going to get a subsidy for your income between $19,720 and $78,000. Now, it's a sliding scale. So obviously, if your income is 78, you're not going to get as much as it is if it's 20K. And it's a huge chart. But basically, if we are working to get you a subsidy, you don't want to do Roth conversions because that's going to add to your income. The only way you'd want to do a Roth conversion is if you have no other income, and obviously we want to keep you above that amount to keep you off Medicaid. So maybe we do a 25, 30, and really for a married couple, this real sweet spot's about $40,000. You can still get a full subsidy and have 40K of income. So we could do that, but you have to be cognizant of this if you're under 65 and we're getting you a subsidy. Some people need to think about taxability of Social Security. So this is more a factor for people who are lower income. But if you're at the point where, let's say your income's roughly, 40, 50,000, you might not want to do a conversion because then you're going to start to see, you might be in a position where you're not paying any tax on Social Security, and all of a sudden you might be up to 50%. And if you go for a married couple more than 44,000, you're 85% of your benefits will be taxable. So, this is another thing to think about when you're doing Roth conversions. And again, this is more for probably lower income. Most clients I have that are retired are pretty much already at 85% taxable. So it's really not an issue, but it could be an issue for you. Another thing to think about is capital gains rates. So if you have a taxable brokerage, or if you have real estate or something like that, if you're going to sell a rental property, you need to think about this because it could push you into a higher amount of capital gains tax. Now, a lot of people I have clients where maybe they have a huge amount of, for instance, I got one client who's got a lot of Apple stock. And what we're trying to do is to keep the client to the point where we stay in the 12% tax bracket. And the reason we want to do that is the client's not going to pay any tax on the capital gains. So for a few years here, we can liquidate some of the Apple stock and pay 0% tax on it. And, being in 12% bracket, you might look at a single person, 12% bracket, it's only 44,000. But remember, there's also the standard deduction, which is, about another, I think, 17,000 on top of that. And then if you have money in bank accounts or other assets, you can still have a decent income. You just work the tax return to your benefit. But the other big thing is, like I mentioned, if you're going to sell rental property, or if, let's say, the client I have with Apple decided to sell a lot of Apple, we want to make sure we try to keep it in that 15% range rather than get pushed into the 20% capital gains rate. So that's definitely something to be thinking about when you're looking to do Roth conversions. The other big thing I get a lot of questions on is the conversion penalty. So technically, it's a 5-year rule. So it says if within the 5-year period starting the first day of your tax year in which you convert an amount from a traditional IRA to a Roth IRA, you take a distribution from that Roth IRA, you may have to pay a 10% additional tax on early distributions. And this, this alarms a lot of people. And the thing is, for each conversion, that 5-year period applies. So if you're doing this over time, that 5-year rule applies. Okay. But there are exceptions to this. And for most retirees, you don't have to worry about this rule. This rule is really for people under 59 and a half. So the exceptions to this rule, and this is an IRS publication. I took this directly from the IRS. The exceptions to the 10% additional tax. You have reached the age of 59 and a half. So for a retiree, even if you didn't have a Roth IRA, so we open a Roth IRA, which has the 5-year rule, and then we do conversions, which each conversion has its own 5-year rule. But if you're over 59 and a half, you don't have to worry about taking distributions from that. It is an exception to the 10% rule. So anybody over 59 and a half, you don't have to worry about that. You just do your conversions. And if you have to take the money the next year, go ahead. There's no issue with it. For people under 59 and a half, there are other exceptions. If you become totally and permanently disabled, you can make a distribution. You are a beneficiary of a deceased IRA owner. So if your child obviously is under 59 and a half, when they inherit the IRA, there's no 10% penalty for them. You use a distribution to buy, build, or rebuild the first home. Now that's capped at $10,000. That's not in here, but it is an exception. Or you do something called a series of substantially equal payments. So this is where you retire before the age of 59 and a half. And you can set it up so that you basically get an annuity from your IRA over time. And that has to last either 5 years or until you hit the age of 59 and a half, whichever is greater. So there are exceptions to this. So for most retirees, and that's where we're doing their conversions, a lot of folks are like, well, we can't do this conversion because we got the 5-year rule. And no, don't worry about it. Don't worry about it. Okay. And as always, we finish with the disclaimers. So if you want to check that out, feel free to do so. Okay. So I know that's a lot of stuff. And it's boring because it's taxes. Taxes and estate planning put people to sleep. But it's important. So, and it's timely as we approach year end. Got a couple questions. Don't you have to pay tax on the entire amount that comes out of a traditional Roth and goes, traditional IRA and goes into Roth. Yes. When you take money out of a traditional IRA, anytime you take money out, it's taxable. So when you do a conversion, it's going to be taxable. And that's why we talked about filling up that tax bucket, that tax bracket bucket. So we're keeping the same tax bracket. So you're not going to a higher tax bracket, but you are going to pay tax on it. And I didn't put a slide in here for that, but what I always recommend clients do, you can do a withholding when you do the conversion. You could have the brokerage withhold federal and state if that's applicable to you. So you can do that, but I always say do an estimated payment. So the next quarter coming up, do an estimated payment with money you've got in your bank account. The reason just being that you get to put more into that Roth IRA. Now, if you don't have the money sitting in a checking account or savings account, well, obviously you probably want to have it withheld from the traditional IRA. But for most people, they've got enough cash to pay the tax on it. So that's the best way to do it, just from a compounding money aspect. So the next question was, basically looking at the chart, the tax rate chart, and just seeing how much money that's exactly how the charts work. So in this case, Chip points out that between $364K to $462,000, you start all the taxes you paid on the tax brackets up to this. I think is that the 24% bracket or 20 or 32? I think that's a 32% bracket. So that 74,208, 32% bracket. 74,208 is all the tax you paid on the 10, 12, 22, 24% bracket. And then it's going to be 32% of the amount above that. So yeah, the tax rates are high, and it's funny. I have clients all the time who get big pay raises or make a lot more money, and they find out, like, I'm not getting that money. Like, why am I still kind of sort of struggling here? I thought with this pay raise I got, I would be just rolling in cash. And it's because your tax rate goes up, and not, plus you have more on the state if you don't, live in a non-tax state. So it's, people make a lot more money, but they don't feel a whole lot richer because they're sending it off to the government. Some states, especially states like New York, California, they're progressive rates as well. But so, I mean, you make more money, but you just don't see it. People in New York City, if you actually live in Manhattan, and, I had a friend of mine who was a tax attorney at one of the big firms there, and he was making like $300,000 a year, but he was paying 50% in tax because he was, single, and he's paying a lot to the feds. So he was up in and this was before the Trump tax bill. So I think he was paying 37%. I think he was almost in the 39% bracket, or he might have been touching into that. So 39%, the feds, and then the state of New York, and then New York City has its own tax. Manhattan does. So he's paying 50%. And then when you throw in the rent, he had a small one-bedroom, it was a one-bedroom place, which was like almost $3,000 a month. He wasn't really making all that much money. Now, the only good news for him was they made him bill out like 100 hours a week. It was ridiculous. We'd go to New York City and see him, and we'd like, where do we go? Where's a good place to go? And he wouldn't know like any of the hot spots because he worked all the time. So, but if he was living a normal life, he really didn't have that much discretionary income left. So, so that's why Roth conversions are very important, because you're going to be passing this along to your heirs, and they might be up in that 30% plus brackets. And if they also now have to pull money from an IRA, it's going to be pretty painful. So, okay, that looks like that's all the questions for the week. So I hope everybody has a really wonderful Thanksgiving, very relaxing, and get to watch the Detroit Lions beat up on the Packers. So that'll be fun, I hope. Yeah, have a great Thanksgiving, everybody. Have a great weekend.